Japan is often held up as a cautionary tale for what can happen to mishandled post-bubble economy. No growth, deflation fears, and rising indebtedness and zombie companies kept alive by low interest rates and banks in denial. Scarily, all these factors are, to some extent, now present in Europe. The continent has arguably already suffered a lost decade and is facing another one. With me to discuss the similarities and differences between Japan and Europe, and hopefully offer some policy prescriptions, is Paul Donovan, Senior Global Economist at UBS. Paul, thanks so much for being here today.
Thanks for being here.
It's a big topic. I'll bring up our first chart. Here we have the yields, the 10-year yields between Europe and Japan. As we can see, Japan has been trending down for some time, so is Europe, but we're converging here. Is this a symptom of Europe becoming a little bit more like Japan?
Well, it's a symptom of a low-risk appetite environment, that people don't want risk, they want the safety of government debt. So to that extent, yes, you can say we're in a low-risk environment, as Japan has been for the last 2 decades, but we get low-risk environments without huge problems emerging. So I would say this is not perhaps the critical issue when it comes to similarities with Japan.
What are the critical issues then?
Well, I think the key similarity is the banking system in the eurozone, and we have to be specific about this. This is not the UK, it's not Switzerland, it's the eurozone. The eurozone banks are basically not lending. The Japanese banks, right from the 1990s onwards, did not lend. What that means is monetary policy is basically powerless as a form of economic stimulus.
If we bring up a second chart, we can see the effect on nominal growth in Japan. Here it is, huge bubble, and basically treading water ever since. Europe, we can see a huge crash here during the crisis. Are we facing a similar period, perhaps of stagnant nominal economic growth?
I think that is the key risk in the eurozone, because the eurozone is basically following the German policy prescription quite a lot. Chancellor Merkel is crying we must have discipline at every available opportunity. The problem with that is if you look at a chart of German nominal GDP, it's even worse than Japan's was. Germany has had a Japan-style lost decade, and I think if we follow that on a continent-wide basis, we risk following a very low nominal growth path in the eurozone.
That's quite scary. Are there any key differences? Are there any sort of cause for optimism that we're not going to go down that, another lost decade period in Europe?
Well, economists struggle to find reasons to be optimistic about anything most of the time, but there are a couple of areas where I think we can be positive. The first is that the ECB has acted a lot earlier than the Bank of Japan ever did. Realistically, it was 1998 before the BOJ even recognised there was a crisis. And 2001 before they started really getting their act together. The ECB's been a lot more aggressive. Secondly, small businesses, the Mittelstand of Europe. Now, the key problem in Japan was the small businesses lost their only customers, the keiretsu, these large groupings of companies. 95% of their output would be sold into these customers. These customers disappeared and the small businesses were just dead. And they were kept artificially alive by the banking sector. Now, in the eurozone, indeed in Europe as a whole, we don't have that. Yeah, we have got companies in difficulties, of course, but nothing like what existed in Japan 25 years ago.
But we have seen, clearly low interest rate environment, fantastically difficult economic environment, but yet the number of corporate failures in Europe, in eurozone, is fantastically low. They're lower than the historical average. In fact, they're lowest in the peripheral countries, which indicates that there must be some sort of artificial forbearance going on there.
There may be in 1 or 2 cases in some countries, but looking at the continent as a whole, we don't have what we had in Japan. The problem in Japan was that the small companies that supplied the keiretsu had no marketing, no product development, no experience of actually going out and selling their product. They basically just did whatever the large companies were telling them to do. And when these large companies went offshore and built factories elsewhere, these small companies were left high and dry with no ability, no experience to go out and develop. Now, Europe has got its problems, but the Mittelstand of Europe does not have problems like that. It's nothing like the Japanese collapse caused by the Indaka process of hollowing out with small business sector companies not knowing where to turn next.
Paul, thank you so much for being here today.
Thank you.
Well, it's fortunate that we're perhaps not facing a problem of zombie companies here in Europe, but the economic tidings are nevertheless fairly grim. Let's hope the European Central Bank is able to avert a Japanese scenario here.